Hello everyone, this is Subrangshu. I welcome everybody to GoFrugal's first webinar session on VAT in UAE. So thank you guys for joining in. A little sorry that we're waiting for everybody to join in. So yeah, we all know that VAT, or value added tax, a tax on the consumption or use of goods and services that is levied at the point of sale, will be live in UAE from January 1st, 2018. Now, GoFrugal, who is one of the GSPs or GST Suvidha provider, a part of the GST network, is known to be a pioneer in multiple taxation structures and policies throughout 35 countries. Now, just to share a small piece of history, VAT was first implemented in India in April 2005. So 3,500 days after, like till this July, the government had changed the structure and policies almost 3,600 times to almost in every single states different tax structures. Now GoFrugal has made it live for 20,000 plus customers and delivered it the changes in the most quickest time. Now I'm proud to share that in UAE also GoFrugal is already 100% VAT ready. Here today we are having a general VAT in UAE webinar, which will be followed by multiple other webinars in the coming few days. Now today I have here Mr.AbdulKader, managing partner of Mars Management Consultants, now one of the famous accounting firms in UAE, with a valid tax accounting license. So I'll pass it on to him in a few minutes. So I'll just share how the format of this webinar is going to be. You can ask questions in chat whenever you have any queries. For those who are in mobile, you will have a question mark in the top right corner, and those who are in laptop can click the questions tab in the GoToWebinar panel and type it there. So first we'll have Mr. Abdul speak for 15 to 20 minutes. Then we will have a Q&A session for a while. Then he will again share some more information in 15-20 minutes. And then we'll have another Q&A sessions for you. So you'll have enough time to type down your questions. Whenever you have any query, you can just write down your questions. In the Q&A sessions, we'll answer. So Mr. Abdul, we start? Yeah.
Hello, good evening to everyone. Thanks, Subranshu, for a nice introduction. Also, let me thank GoFrugal team to provide me with an opportunity to talk on a very hot topic these days and a very important subject which is very near and dear to me. So, the UAE VAT, we will talk in two sessions. First one is the general briefing, and the second one is on its impact on the businesses in UAE in general. So I have a very bad throat today, so please bear with me. Okay. Okay. Why has the VAT been implemented? So the question is, why is UAE implementing VAT? As we all know, UAE federal and Emirates government provides citizen and resident with many different public services like hospitals, road and public schools and park that are paid from the government budget. So very obvious that UAE government wants the new source of income, so that VAT will obviously contribute on the high extent. And also government wants to have a the dependency to be reduced on oil and other hydrocarbon. The second question is, why does UAE need to coordinate VAT implementation with other GCC countries? So in the past, GCC group of nations have historically worked together in designing and implementing the new public policies. So that's why they want to collaborate for this, and which is they think this is the best for the region. Okay, so now the FTA, who are they? The Federal Tax Authorities is formed by the government to administer VAT and excise tax and any future taxes introduced in the UAE. So the tax will be managed by the Federal Tax Authority in UAE. So basically they are responsible for collecting taxes and reviewing taxable person compliance. And available to provide guidance and direction to taxable person in order to support team in meeting their tax compliance and obligations. Decision making capacities in area of tax technical complexities. Responsible for conducting tax audit and administrative penalties. Okay, so moving on. This is just an overview of VAT. Okay, so basically VAT is nothing but tax on the consumption of goods and the services levied at the time of point of supply. Many countries have implemented VAT or a GST. Okay, VAT is collected by a registered supplier down the supply chain. Not all businesses will be VAT registered supplier, and VAT is payable by both businesses and individuals. Some interesting facts are there. So the VAT has been implemented in more than 150 countries around the world. All OECD countries except for the US have VAT regime. The concept of VAT was first introduced in 1918 by German industrialist Dr. William von Siemens. VAT was first implemented in 1954 by Maurice Laurel, Joint Director of France Tax Authorities, Director General in France. So let's talk what is VAT. VAT, as the full form, is value added tax, and as I said, is a consumption tax and is collected on the business transaction and on import. So let's try and break this into six components. So VAT is charged at every stage in the supply of goods and services. VAT registered businesses that makes business use of supply will receive a VAT credit unless they're making exempt supplies. We'll talk in detail what is exempt supplies. VAT is ultimately borne by the final consumer. Yes, there are many exceptions and complexities. VAT or GST now applies in over 167 countries at varying rates. Okay, VAT terminology we'll be using in the presentations so to understand business. So there are two types of taxable supplies. In taxable supplies, we have a standard rated supplies and zero rated supplies. The standard rated in UAE is marked at 5%, and when you're having standard rate supply, you will be able to recover VAT on all the business input you have incurred to run the business. On the zero rated supply, if you have done the zero rated supply, you are able to recover the VAT on business inputs. There is something called non-taxable supplies. In non-taxable supply, there are again two components. One is the exempt supply and the one is out of scope. So exempt supply, the again same outcome for the end consumer. It will be zero rated, but it's a different impact on the supplier. Supplier will not be able to claim the business input as it is allowed in other categories like standard and zero rated. On out of scope supply, yes, generally VAT is recoverable. So that's how it is. I will just take you through the examples to help you understand how the VAT works. Okay, so let's take an example first of standard rated supply. Here, standard rated supply, as I said, is 5% on most goods and services. So let's start with the producer of the goods. He's selling it to the manufacturing entity. Let's assume for the this example that the price is selling at 10,000. So at standard rate 5%, the VAT is payable is 500. So the producer will pay 500 to the UAE federal tax authorities. Now for the manufacturing entity, that 500 becomes the input VAT, and this manufacturing entity will do the manufacturing and sell it to the retailer. Let's say it is sold at 50,000 dirhams. So VAT again will be applicable at 5%, and when the manufacturing sells it to the retailer on 50,000, at 5% rate, it will be 2,500. So that 2,500 becomes the output VAT, and there is already 500 paid as an input VAT to the producer. So manufacturer will be able to claim the input VAT, and they have to pay the net 2,000 to the UAE authorities, federal tax authorities. So that is the second portion of VAT in this supply of chain. Then the retailer, let's say for the retailer, again, that 2,500 becomes the input VAT, and the same goods is sold to the end customer, let's say at the price of 60,000 dirhams. So at 60,000 dirhams at 5% standard rate, the VAT comes to 3,000. So the 3,000 becomes the output VAT, and against that the retailer is able to claim the input VAT which was already paid to the manufacturing company in UAE. So the net is again 500. This 500 is paid by retailer to the UAE government. So, and then the end consumer is the ultimate person who bears the VAT, and you can see in this example that this VAT amount was total 3,000, which was paid by the end consumer, and they borne the VAT expenses. So this is a complete supply of chain where different people have collected tax on behalf of the government, and they have remitted tax to the government at different point of time. So producer at 500, manufacturing company 2,000, and retailer 500. So this is one quick example on the standard rated supply. Moving on, this is the second example on zero rated supply. So as the example is, let's say you're doing the export. Export is at the zero rate. So again, I will just start with the producer, where the producer has produced in UAE and they have sold at 10,000 to the manufacturing company at standard rate. So they have levied 500 as the UAE VAT paid to the government. Then the manufacturing company sells to retailer, let's say again 50,000 dirhams, and the rate standard rate is 5%. So the VAT output VAT is 2,500. So the manufacturing company will again claim the input VAT, which was 500, and then pays net 2,000 to the government. Now this retailer is selling it as an export outside GCC. So export is meant for zero rating. So the output VAT for the retailer here is 0. But because zero rated business can claim the input VAT, so the retailer will be able to claim 2,500 from the authorities. And you can see in this example, the retailer is in the refund situation. So at the end consumer who is not in the GCC, there is no charge, and the UAE government in this case gets nothing out of this whole transaction, starting from 500 paid by producer and 2,000 paid by the manufacturing, and the entire 2,500 was refunded back to the retailer. So UAE government gets nothing out of this transaction because it is a zero rated supply. Let's move on to the third scenario. This is for the exempt supplies. Now here there are I will take you through these examples, which are the examples of the exempt. So the one of the example is the lending of money. So let's take this scenario again from starting from producer. So producer has sold goods at 10,000 to the manufacturing company. Okay, and the standard rate was 5%. So the VAT paid is 500 dirhams. Then the manufacturing entity again, they sold goods at a rate of 50,000 to the financial institution. Financial institution, I've taken the example because money lending is their business. So for the manufacturing company, again, the output VAT is 2,500. They are able to claim 500 input VAT credit. So they pay net 2,000 to the government. Then the financial institution, now because they are doing the exempt business and it is related to the supplies of exempt, they will not be able to claim any input VAT credit. So this is the expense for them. So again, when financial institution is selling it to the end consumer is not going to bear anything, but the the VAT expense as borne by the financial institution in our example, because they were doing the exempt business. But UAE government gets 2,500 in this entire chain of supply chain. So now I'm just going to talk on the types of supply. As I mentioned, there are three, you can see the three pillars. First is zero rated, second is exempt, and the third one is a standard rated. So this is a complete list of zero rated supplies in UAE. So I'll just quickly run through the list. Specified education, specified healthcare, medicines and certain medical equipment, list to be agreed across GCC, international transportation and ancillary services, supply of identified sea, air, and the land means of transportation, exports of goods and services, identified investment grade precious metal, newly constructed residential properties that are supplied for the first time and within 3 years of construction, first lease of new residential, first supply of charitable buildings and buildings converted from the non-residential to residential, and supply of crude oil and natural gases. If you are making any of these supplies, these are zero rated. The second category is of exempt. In the exempt, as I mentioned, for the financial institution, margin-based income is exempt. Rest service-based will be standard rate. Then the second is life insurance, bare land, local passenger transport, and existing residential properties, including student accommodation. The two conditions to meet is lease must exceed 6 months, or the tenant has the Emirates ID if they are giving the residential unit. So this is then the third category is standard rated. So everything else which is not covered in the first two box, which is the zero rated and exempt, is all in the last box, which is standard rated. This includes everything: basic food stuff, commercial properties, water, commercial leasing, property management, management fees, engineering services, imports, goods and services. So the list goes on for the standard one. So what we have to concentrate here is on the zero rated and exempt. If it is not falling under either of these box, it becomes obvious that it is standard rate. The imposition and scope of tax. The business needs to account for VAT when there is a supply of goods or services where it is a taxable supply made in UAE, and obviously for consideration by a VAT taxable person and in the course of business. So these are the basic characteristics of when VAT is to be applied. So if one of these is missing, then VAT is not applicable. VAT also applies to the importation of goods and some services in the UAE. It does not apply where the supply is exempt by law, and it also applies to the deemed supplies. We will see what are the deemed supplies example later in this presentation. Okay, I'm just going to quickly run through the terms which are broadly defined in the UAE VAT laws. The first one is consideration. Consideration includes both monetary and non-monetary. For example, if you have done a barter exchange, so we need to take the value of the goods which have been bartered. Okay, second one is taxable person. Taxable person is someone who is carrying out business, including government, other than if in a sovereign capacity, the business activity, and is required to be VAT registered because there is a mandatory threshold. And I'm sure everybody is aware now, mandatory threshold is $100,000, which is 375,000 dirham annual for the turnover, which includes the import. Goods, all types of material property, including all types of energy, electric, gas, lighting, heating, cooling. The last one is services. Services is a very broad category, which is anything not a good. So if it is not a good, then it has to be services. Deemed supplied is something that may not be an actual supply, but it is deemed for the taxable. So let's take the example, give a business assets or stock away for free where the VAT credit has been taken, were not considered to be a sample or a gift exceeding some specified threshold of low value. So giving a business gift can be a deemed supply, or provide services for a known business purposes. For example, employee uses the company van to move household things over the weekend. So that service may be considered as a deemed supplies for the businesses who are running the transportation business. Okay, the next one is place of supply rules. This place of supply rule is very important for the goods and services. It determines when a supply is made in the UAE. So if it is made in the UAE, it becomes taxable, or if it is outside UAE, then it is not subject to UAE VAT. Just quickly running through this in detail. The place of supply is made and where the VAT may be charged and paid. It determines which country has a right to UAE to the VAT. Proxy for determining where the consumption take place, and there are different rules applies for the goods and services. So services rules and the goods are slightly different when it comes to the place of supply rules. Let's take the scenarios where there is no transport, where it goes where the goods are made available. So if you are running a shop and goods are made available to the end consumer at your shop, that's the place of supply. So if it is in Dubai, it becomes Dubai and UAE VAT. Let's say where the transport is involved, so then the VAT typically due where the transport starts, with some exceptions are there. And then you have a assemble goods. If you're doing assembling of goods, then wherever the assembly is done. Let's take the example of the oil. A UAE trader supplies bulk oil to a US customer, where the oil is transported from UAE to the US. The supply takes place in the UAE where the transport begins, although subject to VAT as the oil is transported from UAE to the US. This is also an export, and so the VAT applies at a rate of 0%. So just give you an example, this is zero rated supply, and the supply is actually UAE based. However, it is export, so it is zero rated. Okay, VAT treatment on imported goods. So I'll just quickly run through an example so you understand. The VAT is also applicable on the importation of good. So let's take the example here. The cost of good which is imported is $10,000. That's the value of the goods imported. Obviously, you need to add the insurance and freight, so it becomes the cost insurance freight value. So in our example, let's take the charges of insurance and freight is 2,000, so the total value becomes 12,000. Then the first duty here in UAE is the custom duty, so we need to pay 5% custom duty on the goods imported. So on this example, if we take 5% on the imported value of 12,600 is the custom duty, then the value of import becomes 12,600 after adding the custom duty. And of course, if it is an excise good, then there is excise duty. So in our example, let's take this is 100% excise payable goods. So there is 100% duty paid on this tax. So let's assume it's $20,000. So now with all this, the value of the goods becomes 32,600. This includes the custom and tax, and the VAT is after all these charges. So VAT 5% comes on 32,600, and then the value is 1630 in these examples. So the end value for the importer is 34,230. So the example here shows that the value on which the VAT is chargeable is the full landed cost of good, including freight, insurance, and the custom duties and excise duty. Okay, this is quickly on the free zone now. So you can see on the left hand screen the companies inside the state. In the middle you will see the companies in the designated zone, and then on the right side you will see the outside state. So if we'll see from the outside somebody is supplying it to the companies in Jebel Ali. So the first scenario, the exporter of goods into the state, that is out of scope because this is out of scope supplies. Then the company, let's take from the example from inside the state. If company is selling it into the company into the designated zone, then you can see there is a standard rate which is 5% applied. Let's take this a third scenario where the company in the mainland is supplying services to the company in the designated zone. So again, 5% is applicable. And then there are fourth scenario where the company is in designated zone and supplying it services to a company in designated zone. Again, VAT is applicable, 5% on the services. And then, sorry, that was example number 4, which is supplier of goods. So then if the goods are moving from one company into another company, there is no VAT. It's out of the scope. And the fifth scenario where the company is selling services within the designated zone, then the standard rate 5% is applicable. Moving into the next one. So again, now let's take the scenario if the designated zone companies are delivering services inside and outside the state. So we'll start from the left side, first scenario, where the company in designated zone is selling goods to the company B in the mainland. So again, standard rate 5% will apply, though the company is in the designated zone. Second scenario, if the company is selling goods to the end consumer in the state, again the 5% VAT will apply. And then the third scenario is the company in the designated zone is selling it to the company outside the state, then this is purely an export which is zero rated. Or if they are selling it to an end consumer who is outside the state, again it is 0%. Then selling it within the scenario of fifth and the sixth. For first example, fifth, if the company is selling the goods, of course, in the designated zone, it becomes the zero rated for the goods. If it is a services, it applies 5%. And again, in the Jebel Ali, if they're selling it to individuals, then of course 5% will apply. So this is quickly the rules for the designated zone. I'll just take you through the exception list to the place of supply for the intra-GCC trade. So let's start from the first box, and the first question we need to ask, is the customer subject to tax in the other member state? And if the answer is yes, then the place of supply of goods or services is where the transport ends, right? And if the answer was no, then the second question comes, do the supplies by the supplier to the member state exceeds 375,000 within any 12 months period? If the answer is yes, again, the place of supply of goods and services is where the transport ends. If no, then the third question we need to ask, is the place of supply of good is where the transport begins? And the answer is no, then we need to check. We need to see if no evidence that intra-GCC transport is in compliance with Article 17, then GCC electronic portal rule will apply. So that means the person is doing e-commerce business. This was just an exception to the place of supply rules. Then these are a couple of scenarios which will help you to understand the place of supply for the UAE. So let's start with the first one, domestic supply, the first box on the left side, where the goods are delivered locally from one state in UAE, from Abu Dhabi to Dubai. So obviously the UAE VAT will apply, goods delivered inside, and it's a domestic supply. The second scenario, or the second box, where the goods are exported outside GCC. So from UAE, it is going to the UK. So obviously this is export and it is zero rating. Then the third scenario is B2B business, okay, and it is an import from from UAE from outside GCC. So let's assume there is a vendor in UK delivering the goods into UAE. So if the goods are delivered into UAE, obviously UK supplier is not registered in UAE and need not be registered. So the VAT is applicable on the importer and the UAE VAT still applies. Then the fourth scenario is B2B supply, the export to the GCC countries. If the goods are supplied or exported to the implementing state, in our example, it is Saudi now, and it is B2B. So this supply of goods will be out of scope from the UAE perspective. And let's say if the goods were imported, and then the last scenario, if it is imported and the goods were moved from UAE to Saudi later on. So at the time of import, there was no VAT, there was no reverse charge done. So now the VAT is applicable, so we need to pay VAT. However, no input tax recovery can be done. And when the goods are transferred or moved to KSA, obviously this is outside the scope, and VAT will be recoverable in UAE, in KSA, sorry. Okay, moving on. When does your liability for VAT arises and need to be reported? So this is just an example which shows you the timeline when actually the VAT is payable as per the UAE VAT laws. So let's take an example. On the 10th of January 2018, the customer orders the goods and pays in advance. Okay, this is the first. The second, on 19th February, actually the goods are delivered. And the third, 2nd of March, the tax invoice is issued to the customer. And the fourth one is the customer pays the balance amount on 20th of May 2018. So there were four different timings for this transaction. But from the VAT laws perspective, the moment the customer has paid in advance, on the 10th of January, the UAE VAT is applicable and you need to pay VAT as output VAT on 10th of January. Okay, just quickly, I will talk about the reverse charge mechanism. How does it works, and what is the purpose of this? So let's say if you are importing the goods into UAE from outside GCC. Now, just to avoid the distortion of the competition locally, the reverse charge has been applied so that at the time of import, you still need to pay the import VAT. However, this VAT is input. You can recover this input VAT. So that's why authorities has allowed you to use the reverse charge mechanism. So basically, in the reporting of your tax return, will just show tax payable and recoverable at the same time. So there is no cash flow impact. However, you need to provide all the information on the tax return to the authorities. So that's how the reverse charge works. So basically the idea is to avoid distortion of competition. It is a mechanism to self-account for the VAT because the supplier from outside GCC is not registered in UAE. They cannot pay VAT and the authorities will not ask the supplier to register and pay VAT. So it is the importer of the goods responsibility to self-account for the VAT. The third point is the idea is in the reverse charge to shift the place of supply and responsibility to account for VAT from seller to the buyer. Reverse charge is on the imported service as well, okay, where the UAE business is registered VAT, and should not be a cost to the business as I explained to you because it is the payable and recoverable at the same time. And the cost results for making, if the businesses are making exempt supplies, it is a cost for them. And difficult compliance requirement need to capture, report and recover. So this is very important that every business is, whoever is importing the goods or services need to use the reverse charge mechanism and disclose all the information of the imported goods and services to the authorities in the tax file return. Okay, so that's all I have on this presentation. Thank you very much, and we'll have a quick Q&A, and we'll try and answer the questions, and then we'll do the next presentation. Thank you very much.
Thanks, Mr. Abdul. I think it was almost everything about VAT in UAE. Now, yeah, we'll have a quick Q&A. So, like I said, I already have few questions here. So, those who are in the mobile application, just press that question mark, and those who are in laptop, you will have the question tab in the GoToWebinar panel. So, to start with few questions, I'll see. All right. So I have Robin here asked me two questions. One is, what is a financial institution? Second, okay, there are three questions. So first is, what is a financial institution? Second, what are the benefits and disadvantages of VAT for retailers? Third, he has asked to explain the 4 time periods of the VAT payment. There was one slide, I think we'll have to repeat that. Okay, thank you, Robin, for the questions. I'll have Mr. Abdul answer you one by one.
Hi, Robin. So thank you for the questions, and these are very relevant questions. So the first one is the financial institution. These are the banks who are doing the lending business. So that those entities will be termed as the financial institution. I think these are monitored by the central bank. Whoever is registered with the central bank to do the lending business. These are the financial institutions. Second questions on the advantage and disadvantage for the retailer. As I explained, this is not the tax on the for the businesses. So for the businesses, it is just the tax you are, as a tax agent, you are collecting the tax on behalf of the government and paying it to the government, and you're charging it to the customer. So there is no expense to the retailers. There is no advantage or disadvantage. It is the UAE law which is applicable. If you're doing a taxable supplies more than 375,000 dirhams a year, you need to register for the VAT and be compliant if you want to do the business in UAE. So as far as the expense advantage or disadvantage is concerned, there is no choice for the businesses to opt or not to opt for the VAT registration. VAT registration becomes mandatory because of the limit, and once you are registered, as I explained, it is not an expense to the business. You can all recover your input VAT. And the third, let me quickly go to the slides where I explained to you the timing of the transactions. So let me again quickly repeat. So let's break this into 4 different stages. The first stage was you received the order from the customer, and as per your company policy, you ask them to pay advance. So you have issued actually advance invoice, and customer has made the payment of the advance. So you, as per the law, the UAE government says on the 10th of January, whatever advances you have received against the order, you need to apply VAT on that advance and pay the VAT to the authorities. So you don't have to wait until the second or third or fourth positions here. So irrespective of goods delivered or the tax invoice is issued or the balance payment received. Hope I have answered your question.
Yes, sir. So there's one more question regarding the same topic. So the question asked is, what about if the goods were ordered before 31st January and advance were paid before 31st January? So, sorry, I'm really sorry, 31st of December, if the goods were ordered before and the advance was made before, right? And the delivery is after 1st of January. Yeah.
Again, this is very good, interesting questions. So because the VAT is getting implemented on 1st of January 2018, so if goods were not delivered before and it is delivered in 2018, that becomes your timing of supply year. And at the time of delivery of the goods, then the VAT is applicable. So whatever it is, irrespective of receiving advance in this scenario.
Okay, so the next question is here from Mr. Nandagopal. So he is heading the GoFrugal accounts team. Thank you, Nandagopal sir, for asking this question. So the question asked is, what are the VAT filing expectations from the government? So what our government is expecting in terms of date, format, on how to file the VAT returns?
Okay, again, very interesting questions. So this is as per our understanding. In UAE, government will have two types of uh, filing of tax return. One will be monthly filing of return, and the second one will be quarterly filing of returns. So the big companies, they have not yet announced the limit of those companies, but my understanding is it will be about 150 million dirhams who are making this taxable supply. Most probably they will be asked to do the monthly billings, and all other companies below will have a quarterly filing. Now, quarterly filing will be not your quarters, it can be quarter for at the time of VAT registration, they will issue you the quarters. So it can be Jan, Feb, March for one, for the second one will be Feb, March, April. So it will be around calendar month, and it will not be fixed for for everyone who but they will give you one quarter to follow for your quarterly return, and the filing format is not yet shared, but it will be online, and I'm sure there will be tools available in the systems which can produce the report, which can be easily then uploaded into the minister's FTA's website, where you can upload all the data for the filing of returns.
All right, thank you, sir. The next question is from Mr. Khalid. So, Mr. Khalid, thank you for asking the question. The question is, so in January, from January 1st, do we need to add the VAT percentage, 5% in the bill, and how can we add it?
Yeah, so again, interesting question. So yeah, this is why we are doing this session, to make the businesses aware that the VAT is coming up. And as I explained to you, there are three types of VAT rate. If you're making exempt supply, anyway you're exempt, so you will not be doing taxable invoices. But if you're doing a standard or a zero rated supplies business, then you need to produce on 1st of January the invoice with the VAT rate. And I'm sure this is easy doable if you have let's say the software. I mean, obviously I'm sure GoFrugal can help you design the invoices which can be generated on 1st of January with rate applicable for your businesses.
Yes, Mr. Khalid, thank you for asking the question. If you are a current GoFrugal user, it's a very simple and easy process. In the coming webinars, we'll be showing you how to do, how to easily migrate your current system to the VAT regime. All you have to do is update the items in the masters and change it in the design. So we'll have multiple videos shared to you, multiple webinars we'll be teaching you that. Here we will be sticking to questions where we are just learning about the VAT right now. So the next question is asked by Robin again. Thanks, Robin. So the question is, in purchase, will the tax be exclusive, or in sales as well? Is it going to be exclusive or inclusive? Is there a rule that has to be followed by a retailer?
Okay. Thanks, Robin. So all your purchases, if it is related to the business expense, and whatever VAT you have paid on all your purchases, there are a few exceptions are there. All will be claimable in the quarter whichever you're going to follow. So whatever VAT you have paid, it becomes the input VAT, and you should be in a situation to claim all the input VAT quarterly.
All right. So I hope that clears. The second question I have actually two people asking the same question. Thank you, Mr. Mohammed Kishk, from asking this, and Nandagopal sir is also asking. It is about the sales returns and the purchase returns. So how will the returns be managed in the VAT regime? So what is the procedure for managing the sales return and the purchase return? Can it be simple, or is there any specific rule asked by the government?
Okay. Again, very interesting questions. So I'm sure with the software we have for the accounting, this will take care of your documentation. So everything is doable. So if you have a sales return taking place after the sales is done, or your purchase return is done to your vendor after the purchase is done, everything you need to you will have to manage the documentation like credit note or a debit note respectively. And if it is systems used for accounting, all this information will be captured, and when we do the quarterly tax filing return, all the information can be taken from the credit note and debit note and the invoices and the purchase invoices, so to account for the input VAT and output VAT, and net can be claimed by the and net can be paid to the authorities. No specific rule. Yeah, obviously there are formatted for the tax invoice and the credit note and the debit note.
So the next question that is related to returns is, what happens if the invoice is done before December and the return is made after January, after 31st December in January?
So again, very interesting question. So actually, the VAT is applicable on um, the time of supply was actually the before the implementation, right? So if the sales happened before the implementation go live, which is 1st of January, there was no VAT applicable. So when the goods comes in as a sales return, obviously there is no input to be claimed.
Okay, so a series of interesting questions. Yes, I have a lot of our existing customers asking us how do we switch to the VAT regime. So like I said, I repeat it again, we will be sending you multiple videos. We'll be again doing a lot of webinars specifically for our existing customers on how easily can we switch from the VAT regime, so the normal regime to the VAT regime. It's just I would say 10 to 15 minutes of process. So please keep joining our webinars. We'll be holding a lot more in the coming few days, and it will be very easy process to do it. Okay, the last question I'll take for this Q&A session, it's from Ladir. Thanks, Ladir, for asking this question. Is this mandatory to maintain purchase or sales data for a certain period of time? Will there be any inspection on those data by FTA? So the invoices, is there any mandatory to it has to be stored somewhere? If yes, what will happen if a customer does not maintain those data, if it's lost or if it's not maintained properly? And uh, what will happen if the customer does not maintain those data, expecting his business will not exceeding the minimum requirement, and at the end of the year it exceeds 375? So I think it's a two-part question. First part is, do we have to store all the data? One. Second, what if we are not storing, thinking that we will not exceed the threshold, but at the end of the day we exceed the threshold?
Again, thank you for a very good questions. So yes, now whoever is not registered as of December now, so first thing for them is to show to the authorities that they are doing the business and they were below the threshold. Now, how do you show them? So obviously the answer is to keep the records, to show them that you are not doing taxable supplies over the threshold limit. If you can prove to the authorities at any given point of time, then there will not be any penalties levied. But if you are not able to prove to the authorities that you are doing it, you are below the threshold limit, then obviously there will be a penalty from the authorities. So it becomes very obvious that if you are not maintaining records, you need to start maintaining records to show to the authorities that you are below the threshold limit. And once you are above the threshold limit, obviously you have to register, and in as per the law, you will have to keep or maintain the records for the 5 years. So I think the answer for the people who are not registered, thinking that they are below the threshold, this is very important that they need to maintain the records, because they will be questioned first before authorities will ask businesses for the registered business to prove on their taxable supplies.
So I think the answer is very simple. If you have not registered as per the FTA rules, you will be asked first. So you will obviously have to maintain the records. As for those who have registered, you have to obviously keep your data as well, because the rule is that you have to keep the data for 5 years. So all the invoices, all transaction where VAT is involved, it has to be there with you whenever the audit is happening for 5 years. Okay, last, okay, I have two more questions, guys. What I'll do is we will take this in the next Q&A session. We will quickly move on to the next session. See, all of you can keep posting your questions whenever you want, wherever you have. We will answer all of these questions in the next Q&A sessions. So which will happen in the 10 to 15 minutes. We'll have our next presentation. The presentation is on how does VAT impact your business. We have added this session because now that VAT is definitely coming in, we want people to understand that how much is going to impact their life, because that's, I think it's a very general question that everybody is asking. So just to share a few things with our experience, with GoFrugal's experience, with what we have seen, how a tax structure has generally impacted business. See, people and our own customers have come to us and told us they have become more process oriented. So it has nothing to do with, because as we have heard from Mr. Abdul, that business is supposed to be tax neutral. So nothing is going actually away from you because of tax, because you are collecting something and back from the consumer. But what has happened, we have seen, because the data has to be maintained, because you are actually paying something to your supplier extra, what people have done is they've optimized their process. So process optimization, I would say, is the first impact of any tax structure, and what you are using to optimize this process. So the standard of technology, the processes, the inventory reduction, the resources reduction, these are the first thing. The process optimization, the first things that I'll be telling is the impact of VAT. In detail, I'll give Mr. Abdul again so that he can explain to you what are the in detail impact of VAT in your businesses.
Thank you, Subhranshu. Okay, so let me quickly run through this slides. I don't have many slides here, but very important topics I wanted to cover, how it is going to impact the businesses here. So this is based on our understanding so far. So as I explained to you, the first one is import VAT for the goods and services. So VAT is payable upon importation of goods, and this will impact significantly the cash flow. But as I explained to you, that there is a special VAT scheme introduced to mitigate the negative cash flow impact, and that is something called reverse charge, which I explained to you how it works. So when you are using the reverse charge, you actually not paying to the authorities at that point of time when you're importing the goods, right? So but there is a slightly deviation if you are importing it for the re-export to the implementing state, then obviously you need to pay the VAT to the UAE authorities. Second one, the designated zone. So now with the executive regulation is signed, it is clarified what is the designated zone definition and how it should be considered. So designated zone, as specified by a decision of a cabinet, shall be treated as being outside the state and outside the implementing state. Conditions are that designated zone is a specific fenced geographic area and has security measures and custom controls in place to monitor entry and exit of individuals and movements of goods to and from the area, and it has an internal procedure regarding the method of keeping, storing, and processing of goods therein. The third important topic is intra-GCC trade. Only special rules for the goods and not for the services. The place of supply for intra-GCC trade will differ depending upon whether the VAT has been introduced, where the customer is. As we speak, out of GCC countries, only two states have implemented or will be implementing on 1st of January, which is UAE and Saudi. Rest of the GCC are going to implement later after 2018. So this will require monitoring and impact of IT systems, because you need to do the VAT coding here if you are dealing in the intra-GCC. Like Oman, Kuwait, and Qatar, and Saudi. So if it is Saudi, it is out of scope because it is implementing state, and the other countries of the GCC as we speak are not implementing state, so it will be a zero rated supplies and it will be considered as an export. The fourth important one is the intra-group transactions. So UAE FTA allows for the group registration. So if you have done a group registration, then you can take the advantage of not applying VAT on your intercompany transaction, and this can be an advantage of a cash flow. Contract, we already answered the questions in the previous one. The supplies made after January 2018 will be subject to the VAT. You should already be considering the impact of VAT on the new and existing long-term contract. So there could already be a significant VAT exposure that will need to be mitigated. Consideration also needs to be given to ensuring tax invoices are received in a timely fashion from supplier. So if you have a contracting business, you need to make sure that all your contract captures the VAT applicability after 1st of January 2018. Employee benefits. Most employer provides employees with many benefits. The VAT laws are impacting few of these benefits, and so this needs to be carefully assessed. For example, you may be deemed to be making a taxable supplies when you give gift to the employees, which exceeds a determined value, uh, and which is or cannot be and would not recover from the employees. So you may end up the gift given to the employees as a deemed supply. So this is very important topic which needs to be considered for the VAT input and output calculation. Entertainment expenses. There are certain entertainment expenses will not be VAT recoverable. So this will become a real VAT cost for all the businesses. Stock write-off and damages. We would expect that when the stock has been destroyed, there will be no requirement to repay previously claimed VAT credit. However, if this if this there is a stock discrepancy, then may be required to repay VAT credit. Return goods and cancel sales. Where you already accounted for VAT on the sales, then when return or customer refunded, we expect you be able to recover VAT previously paid. However, FTA expect that certain commercial documentation to support this recovery are kept. Like as mentioned, you will have to create the credit note and debit notes. Pricing displays. After the introduction of VAT, prices needs to be inclusive of VAT on all the goods displayed for the sale. There could be situation that on the cutover date, which is 31st of December 2017, price would be exclusive of VAT, but on January all the prices needs to be inclusive of VAT. So this is a challenge for the people who are displaying the prices on the shelf for the sale of the goods and the services. Volume discounts and rebate. The value of supply may be reduced in case of a discount if customer has benefited from the reduction in the price and the supplier has funded the discount. So you need to apply VAT on the net amount after the discount. Again, before an adjustment can be made to recover the output VAT, we'll need to issue relevant documentation to support the VAT recovery. Other party will need to write back the VAT credit taken earlier if you are giving a rebate on your sales. So if you're given the rebate later, then you need to adjust your VAT amount on the credit given. We understand that rebate from certain supplier are based on a handshake. So going forward, they will want to recover VAT and so will again need a credit note. So again, very important thing is to maintain the documentation. Next section is sponsorship and barter arrangement. Where sponsorship results in a material benefit in return, then that will be a taxable supplies. Or where it involves a barter, then it can give a rise to two taxable supplies, one by each party. Ideally need to exchange tax invoices for the same agreed value results in a VAT neutral transaction, but it needs to be assessed at a fair market value. Giving vouchers. Voucher defined as an instrument that gives the right to receive goods or services against the value stated therein, or receives a discount but exclude the postage stamps issued by Emirates Post Group. Taxable event occurs when the voucher is redeemed. The issuance or a sale of voucher is not taxable unless the received consideration exceeds the monetary value mentioned on the voucher. So if people have issued the vouchers for their sales, we need to see how and when we need to account for the VAT. Gifts and samples. The gift and sample involves the disposal of business assets free of charge. They are considered to be the deemed supply for the VAT purpose, and the supplier will need to account for the output VAT on the value of the total cost incurred to make this deemed supply. If the value of supply of the goods does not exceed 500 for each recipient of the goods within a 12-month period, then the total value of the output tax payable on all the deemed supplier for each person for a 12 month is less than 2000, then the goods can be used as a sample and no deemed supply occurs. So if you are giving a gift or a samples, this is the value given by the authorities. It's 500 for each recipient, and in last 12 months it should not exceed more than 2000. So if you have samples exceeding 2000, then it will go into deemed supply. Loyalty programs. There is no definition of a loyalty program. Generally, these are a reward program offered by a company to its customer who frequently make purchases. A loyalty program may give a customer discounts, free goods or services. Where a discount is granted, VAT should be accounted for on a discounted value. Excuse me. Promotional campaign like bundle with the goods. If bundle goods received by businesses from a supplier and being sold to the customer as is, the business will need to make sure that the goods in the bundles are of the same VAT category or rate, as the authority will not allow the businesses to charge standard rate VAT on the full price of a bundle if product in the bundle belongs to different categories like a zero rate or exempt. The business will need to communicate to the supplier that bundle goods they send to the hypermarket shall be of a same VAT rate or a categories. Then the last one, promotional campaign, free testing offered to the customer in the stores. So again, the business is offered the free testing of products in the store as a part of a promotional campaign. There should not be a output VAT due on the free samples. It will be an overall part of the cost of sales. Bad debts and the warranties. So bad debt, if a registered company maybe has bad debts, they may be able to reduce the output VAT in a tax period to adjust the output VAT paid on any previous tax period if all the conditions are met. So the application for the refund of the tax should be made only for those debts that are either have been outstanding for more than a period of 6 months and all the recovery efforts have failed, or the customer has become a legally insolvent, and you need to notify the customer of the debts written off, so that if the customer has claimed the input credit, they need to refund it back to the authority so that the authority can refund it back to you. On the warranties are effectively a guarantee issued to a purchaser of a goods by its manufacturer or dealer or retailer, promising to repair or replace if necessary within a specified period of time. There are two types of warranties. One is the manufacturer warranty, which is provided free of charge with the original purchase of good, and the second one is the extended warranty for an additional charge. So if you're given the extended warranty, obviously that is subject to VAT of 5%. And in the supply of replacement of goods or parts, provided they fall within the scope of warranty, should not be should not be a supplier with a VATable purpose, so it will be zero rated. The charge by the business is replacing goods under warranty is is free of charge. And if the manufacturer has funded the warranty and is outside the UAE, then the supply is nevertheless subject to VAT, as the place of supply is the place where the works on the good was performed, that is UAE. So it is taxable. So that's all I had on this presentation, and I thank you all for listening me on this evening. Thank you very much, and I'll appreciate and I'll be happy to answer if you have any more question on this and in the question from the previous session.
All right, guys. So I hope there was a detailed impact on each category of a business. Small things like how bundled goods has to be of the same category that the retailer has to demand from the supplier, loyalty programs. So that was in detail, and thanks, Mr. Abdul, for clarifying every single thing. I want to share that this webinar is being recorded and it will be shared to all of you guys. So if you want to go back to it again, you can actually always see the recording. You can reach Mr. Abdul directly. His email ID is there in the screen. If you have any questions, we are very happy to answer. You can reach anybody of GoFrugal team as well for any doubt that you have. We'll be happy to help you. So right now I'll start with the questions that has been presented. The first question is from Kabir. So the question is, sir, what about the penalties and the fines? So I'm seeing there are separate categories of penalties and fines. So what exactly is the value or type of category of penalties and fines?
Okay, so at the moment, the first stage for the VAT was the VAT registration. So the government had issued three deadlines for the companies to do the registration. For the companies who were doing the business or taxable supply over 150 million, the deadline for registration was 31st of October. Then for the entities who were doing the taxable supply of more than 10 million, the deadline was 30th November for the registration, and for everyone else, the deadline was 4th of December. So if these deadlines are missed, then the penalty was to the extent of 20,000 dirhams. That's what I remember. And now for other, there are lot of penalties are there for the doing the wrong reporting or claiming the wrong input or not charging the output. There are plenty of penalties available on the website and in detail.
So yeah, like I said, there are several categories of penalties and fine. I'm sure the exact numbers can be found in the FTA website. So the first one will be for not registering. And I think the next one that comes on 1st of January is if you are not putting your output VAT in the sales bill or invoices. Okay, so moving on. Thanks, Kabir, for the question. I think it was required as a general question for everybody. Second question is, sir, I think it has been asked by two people. Thanks, Alan, for the question. And Alan and Robin both are asking, if the supplier is not registered to VAT, and if the retailer is registered, so what if I buy from an unregistered supplier? How does it impact my business or my purchase?
So if you have purchases done from the unregistered supplier, I mean, for you are purchasing it without paying any VAT. So for your businesses, you will not be able to claim any input VAT because there was no input VAT paid on those purchases. So you should be okay to do the purchases because as I mentioned earlier, there are threshold kept by the UAE government. So if supplier is below the mandatory threshold and supplying some supplies, then it is allowed for them to do the business. And if the person is not in compliant, then it is that supplier's responsibility and it is not yours.
All right. So I hope that's clear. Next, moving on, a question from Neeraj. So Neeraj is asking, what about the existing stock? So Neeraj is from our Sun and Moon supermarket. So they already have a lot of existing stock. So with regards to existing stock, there are two questions. Will that also be taxed? One. Second, will they get any tax credit on this existing stock?
Okay, again, very good questions. So if you have an existing stock, so it is very obvious that there was no VAT paid on this purchases, right? So now after the implementation date, 1st of January, if you are selling these items as your taxable supplies, you need to charge VAT and collect from the customers. However, there was no input VAT paid on these purchases, so you will not be claiming any input VAT. And going forward, yes, when you do the purchases with the input VAT on the purchases, you will be able to claim all your input VAT. But on the existing stock, there is no VAT paid, so therefore you will not be able to claim any input VAT.
Okay, so hope it is clear. Guys, I'm again asking if there is a doubt on a question that is already asked, you can ask it again. We'll be happy to clear it again. Okay, the next question is from Kabir. The question is, sir, what about chain businesses? Chain businesses like Sun and Moon. So if somebody is running a business with 5 branch, so it's the same trade license. And what if somebody is running a business with different trade license of multiple stores? So in these two scenarios, is the account maintained in separate branches? Will the filing be separate branches or will be of same one single filing? Or how is it going to be, the filing?
Again, very interesting question. So as far as the branches are concerned, for the VAT purpose, they are just considered as part of main license. So for the reporting purposes, they'll be given only one group ID if you want for the main entity. It includes all the branches. So you will be doing your reporting for the head office plus branches all together as a consolidated. However, for the reporting purposes, there is another requirement which we have not covered in today's session. You will have to maintain your books and give information on your tax filing by the Emirates. So if you have a sale, let's say you have a branch in South, for example, Sharjah, and you have a branch in Alain and the branch in Sharjah, so you will have to give that information. The sale has taken place from in which Emirates, because there will be FTA is a federal government and the tax is collected at the central level, and then among the state it is shared based on the information we give it to the authorities where the sale has taken place. Okay.
Okay, thanks, sir. So the next question is there any invoicing format or principle already shared by the government? The invoicing format, obviously the filing format has not been shared yet. We're waiting for that, but is there any specific invoicing format that has been shared?
So far what we have received is there are two types of invoices applicable here. One is the simplified and one is the normal invoices. So the authorities have put a limit. If the invoice is less than 10,000 dirhams, then you can issue simplified invoices. Like when you go to the grocery or a supermarket, you're getting all these invoices for the items with the rate. You did not capture all your information about the customer, VAT ID and everything. But if your supply or your invoice value is more than 10,000, then there is a specific format for which you have to cover information of your customers, take their VAT IDs and etc. So far what we have received is the information on the content of the invoice. They have not issued the actual format. I'm sure they are going to issue in a couple of days time, but we know already what needs to be there on these invoices.
Okay, so the next question is from Alan. Has the final registration dates been extended? So as far as our knowledge goes, no. It was still 4th of December, but please keep checking the FTA website for more updates. They will keep updating it.
Let me also answer this. So the registration what I explained to you, the authorities had issued three deadlines for the companies, right? So registration will remain open for the companies whoever needs to get registered, right? So if you are going to meet your threshold of 375, let's say on 2nd of January, then you will have to still register. So registration will remain open throughout. It's not a problem. But if you had to register because you were meeting the threshold of 375 and your deadline was 4th of December, there was a penalty levied. Now, I'm not sure as I speak that where and how they will collect the penalty, but there will not be a showstopper to not allow you to register. So the registration process remains forever and for all the companies whenever they want to register.
Yes, sorry, thanks for Mr. Abdul to correct me. Yes, the dates are always open. It's just that after 4th of December, if you are a tax compliant business, you have to register after paying the penalty. So for the penalties, again, please check the FTA website for more updates. I'm sure it is 20,000 plus. So you can always register it. There is no showstopper for it. Okay, so the next question is, what about retailers in free zone? So I think Mr. Abdul already covered it in the webinar. We will share the recordings again, Ellen. You can go through it. It is completely explained there. Next question is from Robin. Good question. What about the free goods from supplier, the free quantity? So we tell it the FOC items, free of cost items, and it's like if I'm selling it as a free, like buy to get one item. So again, the promotion. How will tax be levied?
Okay, so again, as I explained in my presentation, if you are giving the samples free of charge, and there is a limit put for the gifts item, so the recipient, the value should not exceed 500 per recipient, and in the last 12 months, again, it should not exceed the threshold of 2000 dirhams. So if it goes beyond that value, then it will be considered as a deemed supply, and you need to pay for VAT. Hope I have answered that question.
All right. Is it clear? Is there any more questions that needs to be cleared right now? All right, then. I think we have come to the end of the session. I will quickly give Mr. Abdul to conclude it. Like I shared again, there will be recording shared to you, all of you guys, and we'll have more webinars coming in. I thank you all from GoFrugal's behalf for joining in. I'm looking forward to all of you getting migrated to VAT very easily with us. And thank you again for joining. So here is Mr. Abdul.
So just my last few words before I conclude. First of all, thank you very much for listening me and with my bad throat, so I apologize. The conclusion I will take it on this session is that whatever so whatever things we have said or whatever things is coming, the big question is how do you as a businessman are 100% ready for the VAT compliance? So the answer is you need a technology which can easily switch you over from your current setup to 100% VAT compliant system. And I think GoFrugal is here to help you with that. And they can do your system VAT compliant very easily. They have already tested in Indian market where the GST was applied and they have a successful result there. Thank you very much for listening. Bye bye.